Hi guys, and welcome back to another episode of the Ginger Realtor Show. Today we have with us for Mortgage Mondays, Baret Kechian from Long Depot. Baret, thank you very much for coming on.
Absolutely. Thank you for having me.
Now, Baret, obviously I know you're busy. You're one of the number one person in Long Depot at the moment, your team.
We have been, for the last couple of years. By a pretty significant amount at Loan Depot, and then I think we finished top 10 in the country the last couple of years in terms of loan production. But we've been busy as anything, though there's definitely less loans closing because it's so difficult for people to find properties.
That is the thing. I mean, and again, look, we had an open house at my personal home yesterday with over 100 people visiting. Just goes to show how crazy the market is. Fingers crossed.
Absolutely insane.
Asking price. So let's jump straight into the market world right now. Rates, I think, are creeping above 4% at the moment. Where do you see things as things stand right now?
I mean, we're definitely seeing 30-year fixed rates creeping up over 4% on just good old conventional loans. FHA is creeping up, just about to 4 if they're not, there. Even adjustable rate mortgages, the 10-year arms, the 7-year arms on the conventional side have gone up. There's not that many options there. And, inflation is not calming down. I mean, with gas prices where they are, with all the supply chain issues, I don't think they're going to do anything to really bring rates back down. A lot of what they're talking about, they're going to be raising over the next, year, where people have heard, up to 1%. That's based on the prime rate, where that'll affect your credit cards, that'll affect home equity lines of credit. That's mostly been built into our market from everything I've read and talked to, in our capital markets group. The biggest concern, of course, is that, payments keep going up on these loans, but people aren't slowing down on their buying. So at some point, there's probably a lot of pre-approvals out there that are basing things on what they saw back in December and maybe haven't even updated their pre-approvals. And I think they're going to be in for a payment shock when they see the difference in rates. It's been over, 1.25% since then.
So, I mean, and again, without trying to put you on the spot, so if I'm buying a house that's $400,000 and my interest rate goes up by 1.25%, 1.5%, off the top of your head, what kind of monthly payment are we looking at difference?
Yeah, I mean, it's, that's a couple $100, $200 to $250 a month difference in monthly payment when you're talking about a 1 to 1.25% increase.
So the one thing I'd be recommending all of my realtor colleagues who are working exclusively or predominantly with sellers is when you're getting offers on your homes, make sure that those offers are up to date as far as the pre-approval is concerned.
100%.
It's possible to have them as far down that pre-approval underwriting passage of time that you can get.
Literally 100%. Even if you've seen where the pre-approval expires in a month or so, our pre-approvals are good for 4 months based on the credit report. If you see that date is coming close, a client may not want us to run credit to update it, but they may also we try to be, as good as we can about reminding them about the rates and giving them payments. But, I'm sure it slips by the cracks of everyone. When they just ask for a quick update, you kind of do it, or one of your assistants does it. But yeah, I mean, and I think most clients are aware, I think they've seen it. They don't have blinders on, but some just don't care. And, some are using the adjustable rate mortgage market as a hedge on the higher loan amounts. We're seeing still some pretty competitive ARM pricing for 7-year and 10-year arms, let's say for loans that are above 647,000. That's the limit pretty much where we can jump into that jumbo category. Even though the loans are harder to qualify, they require more paperwork, they require stringent guidelines. If somebody does qualify, there are some good opportunities at some good 7 and 10-year arms for sure.
And obviously the safeguards in the arms now that weren't there back in 2006, 2007. So you're not having the same issues potentially that they created 20 years ago now.
I think they're totally different products these days, where number one, everything's income documented. Everything requires a down payment of anywhere from, really 20% to get the good stuff. So you have 20% equity, even if there's a 10% correction in the market, those people aren't underwater. And then at some point, they're locked in for the first 7 or 10 years. So it would require someone to really just not check in or do anything for them to just come in and adjust after the 10 years. And even the rates that it would adjust to, most of these 10-year arms right now that are sitting at 3.25 or 3.5, they would adjust down to 3% based on the current formula they adjust with. So where rates are today, they would adjust down. The difference back during those times were that a lot of those adjustables, first of all, were super short. They were negatively amortizing. there were some really risky products out there, subprime loans, where literally the rate you got in the beginning was being discounted by almost 2.5% versus what it would adjust to. Even if the rate stayed the same in the market, it would go up 2.5%. So it's like apples and oranges. I think the current ARM market in certain areas where, you know, somebody's buying a starter home, a starter condo, the odds of them even being in the home for 7 or 10 years are so small that, you know, I would use that as a hedge. I mean, if you're at 4.25 on a 30-year fixed, what are we protecting? We've seen those rates many times. So if you can save some money along the way, it's not a bad plan. In some cases, you don't have a choice. Like, you might have to do a fixed rate because that's all that's available for your scenario. And that's okay. You can still refi the fixed rates too. I do see that in the next 12 to 18 months, we will hit another refi boom, but probably not like we did last year where the rates hit the 2s. I don't think we'll see that, but it won't take that. If rates hit mid 3s, you'll be able to refinance.
Yeah, I mean, if people right now are at 4.25, and it drops down to 3.25.
Yeah, 3.25, 3.5, and we'll hit another refi boom. Definitely, no doubt.
Because you guys have got a couple of interesting products that I've been noting of recently. I think the first thing the person on your team that I know most, Kim, had mentioned was the 90-day lock-in shop.
It's a good product, yeah. Yeah, so it's basically, it's mainly for conventional or FHA buyers or VA buyers, like somebody who's under 647. That's really where it benefits the most. And it allows that person to basically go out and look for a property, but lock their rate up front now so that it doesn't get any worse. Here's the advantage. So like, they have 45 days to locate a property and find a place and get into contract, and another 45 to close, which would be the 90 days. It doesn't actually cost them anything but a refundable deposit. So all they're doing is putting their application in, sending us their documentation, because we are going to actually underwrite that loan and approve them, which is a stronger than a pre-approval approval, like a true commitment subject to an appraisal. They're giving us a $500 deposit basically as a hold. If after 45 days they haven't located a property, they get their deposit back and we go back to square one. If they have found something in that time and rates have shot up 0.5%, they're completely protected. If rates go down, let's say 0.5%, and they're like, oh man, I wish I hadn't protected it, you're getting that lower rate anyway. We have a float down on that loan that's within 45 days of closing. So it's almost like they can't lose. Like, if they're protected against the negative, they get the benefit of the positive. If they find a property in that time frame, and they get underwritten, and so they get a stronger approval. So it's a good product. It's one that you can do when things aren't stupidly busy.
Okay.
If they get to a point where our underwriting department just gets absolutely like flogged with files, you couldn't, because then they're not going to be looking at files that don't have a contract yet. But right now it keeps us busy, gives clients a better chance of getting their offers accepted, and gives them some rate protection to keep their minds safe. Yeah. Obviously, if somebody who took advantage of that maybe 2 weeks ago when the rates trickled down a little bit, I mean, they freaking saved probably 1/4 to 0.5%. When rates had hit like 3.75 right in the Ukraine-Russia conflict, right in the beginning.
Now, how does that compare with the lock your rate with confidence program, which is up to 360 days?
So that one's a little different in that one is actually where you have a property and you're locking something for longer, because you have new construction right now. That could be in a new construction condominium. You could just be in a property where there's a tenant in place and you have to close 4 months later, 5 months later. So we do everything from 4 months all the way up to 360 days in increments. The 4-month one to me is great, because there's a lot of closings right now that aren't taking place for 4 months simply because the sellers have kids in the school system. They have to wait till June. And so in a case like that, you do a 120-day lock, you cap your interest rate 1/8% higher than the current market. So if the market's at 4.25, you have a 4.375 cap. Same thing on the float down. If the rate comes down and we're within 45 days of closing, you're going to get that rate. So if it comes down to 3.5, you're going to get 3.5. But if it goes to 4.5, 4.6, you're still protected at that 4.375. So to a buyer, to me, nothing to lose. Again, it's a deposit. That deposit is 0.5% of the loan amount. So on a $400,000 loan, they would give us $2,000, fully refundable upon closing or upon cancellation.
So from what I can see here, this is 2 products that you guys have gone away and really thought about. Locking in a rate for someone who hasn't found a house yet and is still shopping.
That's right.
With a refundable deposit. And then for those guys who have found the house, and again, as someone who works with both buyers and sellers, you have the situation where either A, you have tenants in, like you said, or B, the seller just hasn't found that house yet and just keeps pushing it 30, pushing it 30. So that means
happens all the time.
I have clients who you financed who lost out on that by I think 0.75% it was at the time.
That's right.
Because their seller hadn't found a house and kept delaying things. So this kind of a product sounds like a
Yeah, it gives the buyer a little bit of confidence. You know, it's not for every product that we have, but at least for that, you know, buyer that's going on like an FHA, VA conventional loan, and even you can use it for high balance conforming loans too, even though those rates have gone up. It gives you at least something, you know, that, and those first time buyers are the ones that are the most worried. You know, their budgets are really important to them. Somebody buying a $500,000 house that's at the peak of their limit because the properties went up so much, that guy's worried about the $50 a month because he's already at his budget. So for somebody like that, it gives them certainty. The second thing it gives you certainty on, and we actually discuss this with our new construction clients that call us as their preferred lender, it gives you certainty that the loan is not going to get denied because the rates went up too much and now the payment went up and now they can't afford it because you have the worst case scenario locked in. So as long as you have your approval based on that worst case scenario, there's no chance the loan gets denied at that point just because of something out of our control. And so in some of the cases, like we have a complex in Florida that one of our other loan officers was working on, some of these things are 8 months out. And they don't want a case where a 0.5% increase in rates causes the debt ratio to go too high, where they can't afford the home anymore and they can't get the approval, or we have to take back the approval. This avoids that.
Obviously, I'm assuming that with these extended rate locks, the clients don't have to maintain their credit to be approved for the loan, but from a rate perspective, it stays the same.
It stays, yeah, exactly. So they, you know, again, their only responsibility is provide the paperwork. The documents are still only good for 4 months, so they will have to, like, obviously update their documents at some point. That you can't control. Any new construction lender knows that, obviously, in their case, like, they're going to have to go through it. We've given them all the warnings up front. We let them know what they can and can't do. If they change jobs or something, changing jobs isn't a death sentence. It's just let us know up front. And as long as the new job has a salary, we can use it. We've had cases where somebody starts a new job in the middle of the loan process, and that's not even going to start until after the closing. And that's still okay. As long as you have their employment agreement or contract or the offer letter, and we confirm with the employer that they've been cleared to work, they can still do that. Because then there is a lot of job movement going on right now. We're seeing an incredible amount of that because with COVID, you know, obviously some people got used to working from home. And if a company says, you know what, we want you to come in, and they can't for whatever reason, and other companies are allowing them to work from home, we're seeing some movement. We're seeing some movement in certain industries with higher incomes. So, you know, all cool things to remember. But yeah, we give them the warning, but the rate at least is not something on their mind. Everything else they still have to keep up with.
Fantastic information, Baret, and thank you very much for taking the time out of your day. I know it's really busy over there in Jersey City at the moment. Now, Baret is able to write loans for you, whether you're working with me in New Jersey or you're working with me down here in Virginia. Baret, thank you very much for coming on today.
Thank you so much, man, for having us. If anybody has any questions, feel free to reach out anytime.
We'll put Baret's information on the screen, which will be down one of these sides. Never did we work it out. But we'll be back next Monday. We have Eric back next Monday for Mortgage Mondays for this week. Baret, thank you very much from Loan Depot. We will see you all next week.